Hello and welcome to the fourth episode of Trust Tactics. I'm Caldwell, Deputy Editor of Money Observer magazine. Today I'm going to be talking about the key advantage investment trusts have over open-ended funds. Before the start of June, the main advantage investment trusts have over funds was overlooked by some investors. Instead, they would typically cite other features of investment trusts the funds do not possess, such as the ability to gear or for a trust to trade on a discount. The key structural advantage that outweighs them all, though, is the fixed pool of assets. Investment trusts, like unit trusts, invest in a basket of underlying assets, such as equities, bonds or property. But unlike funds, they are companies listed on the London Stock Exchange. Essentially, there are two layers of activity. There's a fixed number of shares issued, which raises a fixed amount of money for the fund manager to invest in a portfolio of assets. Investors trade their shares on the stock market. When the trust is doing well, there's more demand for the shares in it, and vice versa. This means the fund manager does not have to sell or buy holdings in their portfolio of assets as investor demand varies. This allows the fund manager to take more of a long-term view. In contrast though, for open-ended funds, problems arise when there's a big queue of investors wanting their money back at the same time. In order to raise cash to give investors their money back, the fund manager has to sell the investments held in the fund, which are called redemption requests. This can create a vicious circle and can create a fire sale scenario whereby investments are being sold at knockdown prices. When the investments being sold are not easy to trade, the problem is heightened, as Neil Woodford and his investors found to their cost. His holdings in illiquid companies led to his Woodford Equity Income Fund putting a suspension in place at the start of June. This then leads me on to the final point that needs to be made, which is that investments that are not so easy to trade quickly, so-called illiquid investments, which include unquoted companies and property, are best suited to the investment trust structure. In contrast to open-ended funds, because investors in investment trusts buy and sell their holdings on the market, the price of their shares might be forced down, but there is no risk that the fund manager will have to sell down the investments held in the portfolio in order to cover redemption requests from investors.